Good afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before I introduce today's speakers, a few quick reminders. Everyone that is registered for today's program will receive a copy of the recording by Friday or early next week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Now join me in welcoming back our friends at Moss Adams. This time we have Dan Cheney, CPA Tax Partner, and Kelsey Schoberg, CPA Tax Manager, both specializing in the Automotive and Dealer Services Group. I was a communications major in college, which is probably why I'm hosting and not presenting, so I'll leave you in the hands of our pros. Take it away, guys.
Thank you, Rachel. So the design of this session really, there was an earlier AutoTalk webinar that went into the tax reform and probably a little bit more in detail. We're going to review some of that stuff because I think there's so much out there that it's really important that you probably can't talk about it enough. But our real focus is going to be what should be done before the end of the year, what are the tangible takeaways specific to auto dealers, and so we're going to try to really kind of narrow down onto those types of topics. So Rachel introduced us. I'm the national practice leader of the automotive practice for Moss Adams, and for those that don't know, we serve dealers in pretty much every state in the United States, big national practice, large firm, CPAs and business consultants. That's kind of who we are. And for Kelsey and I, we live and breathe dealers.
Yes, yes. And as Rachel said, I'm Kelsey Schoberg. I am also a CPA with Moss Adams. I work primarily with our Automotive and Dealer Services Group, specializing in tax compliance and consulting for dealership groups of all sizes and their owners. So just to give you a little bit of an overview on what we're going to talk about today, as Dan mentioned, we're going to really focus on the things that impact dealers the most. This could be a all-day presentation if we wanted to go in detail on everything that changed, but we want to really focus on the items that affect you most. So first, we'll do a brief update on those items, give you some background, kind of just to refresh your mind on some of the major rule changes. Then we'll talk a little bit about the key guidance that has been released to date and discuss the impact on the automotive industry. And also, we'll point out some of the items we are still anxiously awaiting IRS guidance and when if we know when those will happen. And lastly, we'll talk about some action items and things for you guys to think about before the year end closes.
So maybe a little history. So early in, or I guess in the fourth quarter of 2017, the House and Senate both came up with bills for what they wanted tax reform to look like, and then the conference committee changed a lot of those. And there was a lot of kind of industry consultation that happened during that first stage. For the automotive industry, it was specifically with the House. And then some of the things that were agreed to and some of the things that we wanted to accomplish ended up being a little bit different when it came out of the conference committee. The president signed it into law in the last few days of the year last year. Didn't give us a lot of time for planning around any 2017 implications. And then during the year, we've been receiving additional IRS guidance on specific areas, and that guidance is very important because even though there's 1,500 pages of law, when you get into a specific area, we may be relying on one or two sentences in a code section to understand what that law meant. And so we've received guidance in many areas. We're waiting on guidance on many other areas. And so it's kind of the wild, wild west of tax law, the environment we're living in today.
Yeah, and like Dan said, this is an ongoing process. We'll be receiving guidance for several years to come. And another important point to discuss is just we might have a change in the political environment coming in 2, 4, 6 years. So while these are the rules right now, and some of these rules are, quote unquote, permanent in the tax code, that doesn't mean that new administration could come in, new Congress that could totally change it. So we just want everyone to keep that in mind, that these aren't the forever set in stone rules when you're thinking about, restructuring and doing things to maximize your tax benefit under these rules. We want to keep in mind that this might change. So now we'll get into just some of the key changes that were implemented with the Tax Cuts and Jobs Act. Like I said, these are the ones that really impact dealers the most. Really at a high level, the overall tax rates decreased. So for individuals, the top tax rate decreased from 39.6% to 37%. So not a huge decrease there, but we'll get into a little bit later on how pass-throughs kind of reduce that a little bit more. For C corporations, there was a dramatic tax decrease here from 35% to 21%. With C corps, there's still that double taxation, whereas in the business itself is taxed at a 21% rate on their income. And then when that income comes out to the shareholders, you also get a tax on the dividend. So there's still a double taxation, and we can talk a little bit more later on how that changes in comparison to a pass-through. So the third bullet here is a major one. It's one that impacts the majority of businesses and most of our dealers. This is the pass-through deduction. This was a way that Congress said, we're giving C corps this huge tax deduction, but we recognize the vast majority of businesses are actually pass-throughs, and how do we make sure that pass-throughs get this deduction? So that's what this is accomplishing here. And what it does is for qualifying businesses that are eligible, you get a 20% deduction before paying tax. So effectively, it means you pay tax on 80% of your income for qualifying businesses. What this really comes down to is that this leaves pass-throughs with a 29.6% tax rate. So we won't get into too much on what businesses qualify. Dealerships certainly qualify. The businesses that are excluded are professional services businesses like attorneys and, unlucky for us, CPAs. There's other hoops to jump through to make sure you qualify, but for this discussion, we'll assume that for the most part dealers qualify. The maximum deduction here is 20% of your qualifying business income. You have to jump through a few hoops to actually maximize that deduction. So your deduction cannot exceed 50% of your wages. So if you have a business that doesn't have any property and doesn't have any wages, you're probably not going to get this. That's why we say dealers wages are a huge part of dealerships, so you qualify. The other caveat here is you can also get that to the extent that you have basis in property.
Under a little bit different math there, but
yes.
Again, we don't need to get into the details of that. To get the benefit of the significant rate deduction passing through the taxpayer for a pass-through entity, a give back was this limitation on interest deduction. And so your interest is now limited, how much you can deduct as interest expense, to EBITDA, 30% of EBITDA, which is earnings before interest, tax, depreciation, amortization. And there's some clarifying description of what that means, but one of the big three expenses in automotive industry is interest. And so NADA and others in the industry were pretty in tune with this being an issue, this 30% limitation on interest, with floor plan interest being such a significant amount. And so through that process of drafting the House bill, there was some negotiation with the industry that resulted in an exception to this 30% limitation for floor plan interest, but there was also a give back, and the give back was some limitation, or maybe a complete limitation, on the ability for dealers to use bonus depreciation. This is an area where regulations are going to be very important, and they are still not issued. How broad is that limitation on using bonus depreciation for dealers based on being allowed floor plan interest? And does that limitation cross over to other entities in the same ownership group or other entities that are aggregated with the dealership? There's not a lot of clarity in this, and so we're having to navigate kind of the best strategy to implement as year-end approaches. With bonus depreciation, there was significant change in that bonus depreciation went up to 100% bonus depreciation, and this is different than Section 179. bonus depreciation, the rule used to be that it was only for first-time use new property. Now bonus depreciation is also allowed for used property. And when you think about things like a buy-sell transaction with a dealership where you're buying the assets of a dealership, you may have significant deductions on the fixed assets and other things if you're allowed to take bonus depreciation at a dealership. And so for the real estate entity, maybe there's an opportunity, and we'll get into that later, but the bonus depreciation rules were a significant additional deduction and a significant limitation for the automotive space, which is somewhat frustrating.
Yeah, and the other thing to point out there, you have bonus depreciation as one way of accelerating tax depreciation, but there's also another avenue, which is Section 179. I promise we won't throw out too many code sections, but I think that's one that people usually refer to as 179. But it basically allows for smaller dealerships, if you have acquisitions of less than $2.5 million for the year, then you can accelerate depreciation up to $1 million of 179. So there is some flexibility there, and we can utilize that, but the best option is bonus depreciation, and that's the one that there's not clarity on that. Where we're thinking right now is until we get more regulations, we don't think dealerships or businesses with floor plan interest can take bonus depreciation.
Yeah, and that $2.5 million limit, a number of dealers, I would say probably a large portion of our clients exceed the $2.5 million of asset additions in a given year and are not able to take 179 because of it. So it's a give back that didn't work out very well for dealers of scale. And in one area you might say, well, we never spend $2.5 million on equipment for our service department or furniture and fixtures. That's a pretty rare event, but most dealers have pretty significant loaner fleets, and those loaner fleets would also count as Section 179 property that would potentially limit you on that deduction. So it does apply, and part of the negotiation, and this is probably worth pointing out with the House, was that at the time the Section 179 deduction was going to be limited to like $10 million, or I can't remember the specific numbers, but in conference that got changed. And so not a great answer for dealers, that the 179. For a smaller dealer, you probably have an opportunity here, but for a lot of dealers, 179 is not a great answer, and bonus depreciation is a great answer if we can use it.
Mm-hmm. Yep. So next, there was a change in how you can deduct state income taxes. This applies specifically to individuals and to pass-throughs. C corporations can still deduct their state income taxes, but to the extent that income tax is paid at the individual level, you do not get a deduction in excess of $10,000. So this was a big item that was discussed when the Tax Cuts and Jobs Act was passed, in that if you're in a high income tax state, or you have businesses in a high income tax state, this is likely going to have an impact on your tax returns. This is something important to be aware of. There's also some limitations on deductions for meals and entertainment. It's important that especially the controllers and CFOs know, so that we're tracking this accordingly throughout the year. But really what happened is, under old rules, if you brought pizza into the dealership, or if you brought food into your business, for the benefit of keeping the employees there and working, that used to be 100% deductible. That's not the case anymore. So that's 50% deductible. And really, in theory, a good way of thinking of it is basically all meals now are 50% deductible. And the only real things that meals-wise that are 100% deductible are holiday parties, company picnics, and those types of things. In terms of entertainment things like box seats to a game, golf events, things like that used to be 50% deductible to the extent it related to business. Now that is no longer deductible. So keep those in mind as you're coding those things throughout the year.
And just a real quick comment, we'll move into kind of the strategy section next, but we wanted to revisit this stuff because it is significant, and there's a deeper dive on a prior webinar that we did that can go into this more. Just a couple more real quick points. Changes impacting non-controlled foreign corps. We start saying acronyms like NCFCs. People probably, their eyes roll back in their head. What are you talking about? Pooled arrangements with your extended warranty company where you have a foreign entity that you have a minority ownership in. Those types of arrangements, the definition of what a passive foreign investment company changed under tax reform. And because of that change, it is challenging for those entities to not be a passive foreign investment corp, which all of that's really hard to understand. I think at the end of the day, the point is that we're waiting for guidance in the form of regulations that define whether existing structures are a passive foreign investment corp, and there's elections that need to be made if they are. So they're a little bit of in a tenuous place with those non-controlled foreign corps, your extended warranty companies that are pooled, not your typical, more common CFC, controlled foreign corps that file U.S. tax returns and all that. Just a couple other things. There was changes to the tech term rules for partnerships. There's personal property like-kind exchange changes. There's loss limitations on pass-through entities. There's changes with regard to building things in opportunity zones. I could go on for hours. There's a ton of changes, but those are less common in dealerships, so we just wanted to highlight them. So on IRS guidance, in August of 2018, the aggregation rules came out for the 20% deduction. So earlier we talked about most dealers have enough wages to qualify for the 20% deduction, and what does it mean for a group of entities, and how do you allocate those wages across entities? And so in August, the IRS did issue regulations in this specific area that were pretty taxpayer friendly, and we're hopeful that that speaks to future regulations being taxpayer friendly, that allow for pretty broad aggregation of entities, so that if you're, for example, a single point dealer that has the dealership in an S corp and the real estate in a partnership, under this set of aggregation rules, you could aggregate those two entities and allow the 20% deduction, the wages for the dealership to be allocated to the dealership and the real estate entity, and get the 20% deduction. And so there's some strategies around how you aggregate your businesses, but those aggregation rules were very important clarity and was very helpful from, kind of figuring out how this is going to play out for the rest of the year.
Mm-hmm. Yeah, and they also in August released bonus depreciation regulations. They really just provided guidance on what qualifying property is, but unfortunately there wasn't any guidance specifically related to businesses with floor plan interest and their ability to take bonus depreciation. So we didn't get a whole lot of clarity for dealers there. There was also some guidance released related to the business interest deduction. It was in April, a notice 2018-28 was released, which really it provided interim guidance for a few things for us to rely on before the regs are issued. In this notice, they really stated that the IRS intends to issue regulations specifically related to floor plan interest, but that has not happened yet. So nothing really there.
And there is a number of areas that we are still awaiting guidance from the IRS, and a few firms and NADA and some to some extent AIADA, we've worked with the IRS to ask for clarification on specific areas that we need for automotive dealers. And one of those is this interest deduction limitation for businesses with floor plan interest. There's some language in there that sounds like potentially if you had less than 30% interest and didn't need your floor plan interest, weren't limited on your floor plan interest, would you be able to get bonus depreciation? Based on the way we understand it today, our answer would be no, but there may be guidance from the IRS that would clarify that. Bonus depreciation rules for related real estate entities. How broad does this dealership taint impact the bonus depreciation opportunity for related entities, for a separate but related entity, and how does it impact if you've grouped those entities or you've aggregated those entities? Those are areas we still don't have guidance. Guidance on this issue I brought up a few minutes ago with the pooled arrangement extended warranty company. There's still not guidance on that. So There's another area that I think is probably less likely of a concern, but for management companies where you have a management company structure, is there concern that that's a service business that isn't like an accounting firm that doesn't qualify for the 20% deduction, and making sure that it's clear that that is still a dealership activity and does qualify for the 20% deduction? We're asking for guidance in a number of areas.
Yeah, still a lot of unknowns there, and we're anxiously awaiting information from the IRS. But absent that, there's still a lot of things you can be doing towards the end of the year and planning considerations you should be thinking about. So first, related to the 20% pass-through deduction, it's really important that you are analyzing your specific entity and your specific group to make sure you're maximizing that 20% deduction. Really, this is related to aggregation. You want to look and understand your ownership structure. In order to aggregate, there's some rules on making sure you have common ownership. So really the point here being, the larger the group, the larger the owner base, the more complicated this is going to be. And it's better to start addressing this now than getting to April and starting to think about it and realizing you have a lot to dig through.
So another area is, if you're familiar with an extended warranty program, typically there will be an additional cost added to the warranty at the dealership level that then gets paid back to the dealer individually, commonly called over-remits. Really, it's a cost of sale at the business that should be profit in the dealership. Those items come out to the individuals as a 1099 and may not be eligible for the 20% deduction at the individual level. And so looking at your over-remits and redirecting them through the management company or through the dealership is probably something you should be considering. A couple other things. At this point, we do not know the floor plan interest deductions implications on related entities, but at a minimum, the safe approach would be to pay for your leasehold improvements and other bonus eligible items at the real estate entity level, not in the operating dealership, in order to maximize your opportunity of getting bonus depreciation on those items. And another one is looking at if you are participating in a pooled warranty relationship, you should be talking often with your team on that activity and find out if we are going to be a PFIC for 2018. And if you are a PFIC, there's an election. It's called a Qualified Electing Fund election that provides some protection over prior years' capital gain nature of your reserves in that entity. And so paying attention to that issue, making sure if we do get guidance before the end of the year, if we do in fact need to make a QEF election, that may be something you need to do before the end of the year, and it is something that you need to be paying attention to and engaging in.
Yep. Yeah, if you have an NCSC, be talking with your advisors now to really understand that. Next, talking about charitable gifts, there is some planning around that to really make sure you're maximizing your deduction. The thought behind this is the standard deduction is now doubled, which means that far less individual taxpayers will be itemizing, and you will effectively not be getting a benefit from those itemized type deductions, which includes charitable gifts. So if you aren't thinking you are going to itemize, then it makes sense to think about pooling your charitable contributions to do 3 years worth in 1 year to really maximize that deduction. Next, if you're looking at a transaction on the buy side or specifically on the sell side, there's a lot to be thinking of here in terms of tax reform. One example of this could be if you're on the sell side and you have a big LIFO reserve that you will recapture when you sell your assets. There's some planning to be done around that. You want to make sure that you're not selling at the beginning of the year and that you can maximize your 20% deduction on that LIFO reserve. So planning for sure around that. As you get to the end of the year with all these changes, it's important that you're planning out your tax strategy and you're calculating what tax you will owe in April. I think especially with the bonus depreciation changes, for other businesses, it's easy to say, man, I'm going to be able to write off everything lower tax rates, easy answer, April's going to be easy. But that's not quite the case in a lot of situations. So it's really important that you understand that to avoid any surprises in April. Lastly, just something to think about, might want to evaluate the benefits of extending your 2018 tax returns. That doesn't mean you have to extend out actually having the work done, but think about holding off on filing until we get more guidance. It's very possible that we might get guidance in June on bonus depreciation, and had you filed your returns in April, you may have not taken that deduction, and you may have to amend as opposed to extending your return and just taking that deduction later on.
And it's interesting because when we think about the tax law that existed before, it wasn't just the regulations that we had to rely on. We had tax court cases. We had numerous opportunities to find clarity in what that law meant. And so what clarity will be, we'll get regulations, but there will be further developments, notices, revenue procedures, everything else that will continue throughout the year. So given that environment, it really does make sense to give yourself as many options as you can. And it's probably one of those times that if there was ever a time to think about extending, I completely agree. It's that time. So key takeaways, you got to understand your individual situation. We're dealing with dealers as, single point. They own their own real estate, 30, 40, 50 store groups, complex management structures, ancillary businesses that are different than a dealership that are operating. Do those businesses qualify for the bonus depreciation or for the 20% deduction? So this is the time to be really engaging in planning for tax more than you probably ever have before. And look out for IRS guidance as the year, work with your tax advisors, and expect to spend more time, not just on tax compliance, but also on the planning side, because it's going to be a moving target, and we don't want to make short-sighted decisions in this maybe short window, maybe long window of a pretty friendly taxpayer environment.
Yep. Yeah, and I know Congress has been really pushing for this whole postcard tax return thing, and right now we don't really see that happening anytime soon. So back to what Dan said is really understand that this is going to take a lot of time and planning to understand these rules.
Well, it looks like we have just a moment that you can ask questions through the screen. One of the questions that often comes up is whether a C Corp makes sense in this environment of a low C Corp rate versus the 29.6% rate on pass-throughs. And we've looked at it under a number of scenarios, and it's a pretty narrow gate where a C Corp can make sense. In almost all instances, you're still in a better situation with the pass-through. And keep in mind that we have a much more volatile tax environment. The threshold to make tax law changes is now 50% majority, not a two-thirds majority in Congress. And so with a change in administration, potential as early as 2021, having a dramatic swing in tax law is real. So making decisions that will survive another change in tax law that still makes sense, you got to have that context. And so definitely worth considering in certain situations, high income tax states and things like that. But very limited benefit, and pass-throughs still seem to be the best answer for most.
Dan and Kelsey, we appreciate you taking time out of your busy days to join and enlighten us. Tax reform is here to stay, and the best way to understand it is to get educated. So thanks again. Their contact information for everyone listening is right there on the screen, and again, you will get a copy of this recording. To wrap up another successful year of AutoTalk, on December 18th, join ADESA's Tom Contos and Cox Automotive's Jonathan Smoke as they present the year-end roundup and their predictions for 2019. Be on the lookout for promotions on how to register. For more information about AIADA, visit AIADA.org or call 1-800-GO-AIADA. Thanks for joining us, and have a great day, everyone.